Hello, everyone. This is Marcus with your not so weekly tax tip. So let's talk mutual funds. A lot of times, taxpayers receive tax surprises at the end of the year due to the actions taken by the mutual funds that they own. And what can add insult to injury is that the unsuspecting taxpayer who recently purchases shares in a mutual fund can immediately be taxed on their recent investment. So, how does this happen and what can you do about it? All right, let's discuss. Towards the end of the year, many mutual funds pay a dividend to the holders on record as of a set date. The fund might also distribute funds deemed as capital gains based upon buying and selling activity that takes place in the fund throughout the year. And this can create many problems. Let's outline them. Number one, there's taxable paybacks. If you purchase shares in a mutual fund just before a distribution of dividends, part of your purchase includes the dividends that are effectively paid right back to you. Not only will the asset value of your recently purchased shares in the mutual fund go down after the distribution, but you will owe taxes on a distribution that is effectively your own money. That's number one. Number two, let's talk kiddie taxes, right? So many taxpayers purchase mutual funds in their children's names to take advantage of their lower tax rates. And by keeping their child's unearned income below $2,100, the tax is low or non-existent. A surprise dividend or capital gain, though, could expose much of this unearned income to higher taxes. So beware. And then last is the $3,000 loss strategy. So each year you can take a net of up to $3,000 in investment losses. Your losses can offset high rates of income tax with correct tax planning. But first, these losses need to offset capital gains. If you receive a surprise capital gain, you could be reducing the effectiveness of this tax strategy, which of course we employ here in the office. So what can you do? All right, so here are some ideas to help reduce this mutual fund tax surprise. We'll call it tax surprises. So what can you do? Number one, you can limit year-end activity. So you can plan your mutual fund moves with this year-end surprise in mind. So you have to consider reviewing and rebalancing your funds at the beginning of the year to avoid purchases just prior to dividend distributions. That's number one. You can also research your mutual funds. If you wish to avoid year-end surprises, do a little research on your mutual funds to anticipate what will happen with that fund. You can check out the historical trends of your funds to determine which are likely to issue a surprise, a 1099 dividend form or a form 1099B, which are capital gains and capital losses. And then, of course, you need to be able to use the knowledge to your benefit. If you like a fund and it has a practice of creating taxable events each year, consider investing in these funds within a retirement account. That way, the tax implications can be part of your overall retirement planning. Now, I know this. I know that no one likes tax surprises at the end of the year. And the best course of action regarding mutual funds is to consult with a tax expert who can help you navigate those options that are best for you. That's all I got. Thanks for hanging around for the Not So Weekly Tax Tip. Until next time.